Good evening, everyone, and a very warm welcome to today's session. It is my pleasure to welcome our esteemed speaker, Dr. Shaukat Panjwani. Dr. Panjwani is a distinguished pediatrician from Vapi, Gujarat. We are truly delighted to have him with us today. Without further ado, please join me in giving a warm welcome to Dr. Shaukat Panjwani. Over to you, sir.
Thank you very much. So first of all, I would like to thank WealthCon and Dr. Ram sir for giving me this opportunity to interact with all of you on this wonderful journey of financial freedom. I would like to start my talk with this beautiful slok from Sanskrit. Asatoma Sadgamaya Tamsoma Jyotirgamaya, meaning lead me from the unreal to the real and lead me from the darkness to light, ignorance to knowledge. We all know that WealthCon is founded by Dr. Ram sir. He doesn't need any introduction, but he is a medical professional with MBBS and MD in radiology. He is practicing radiologist based at Mumbai with extensive clinical experience. Apart from being a radiologist, he has various qualifications, which includes MBA in finance, diploma in taxation, certificate research analyst, AMFI certified MFD. Currently, he is pursuing MA in economics. And he has more than 20 years of experience in investing, trading, combined with the academic knowledge with the practical market exposure. Till now, Ram sir has trained more than 95,000 doctors across 12 countries, including India. I am Dr. Shaukat Panjwani. I am working as a consultant pediatrician and neonatologist at Olive Multispeciality Hospital, Vapi. I start my talk with my financial journey. So when I joined as an postgraduate student in the pediatrics, I started earning as a stipend in PG. And one of my relatives told me that you should start investing in LIC policies. So I invested in 3 LIC policies and 2 regular mutual funds via the agents. Didn't took any insurance. And after joining WealthCon in 2017, I came to know that we doctors are very illiterate about the finance. We are taught so many things regarding the medical practice, but during school also and in medical also, we are not taught any things related to finance. So I started reading slowly, I came to know that the regular mutual funds are not good and they take a good amount of your portfolio. So I applied the Karisa criteria. I stopped the regular mutual funds and invested in the direct mutual funds. I surrendered all the LIC's policies and opened the Demat account in 2017. I started equity buying, did my TMP from the first batch of the TMP, that was a rainfall batch, and started FNO trading in 2019. Since then, I became a guide, senior guide, and author in many WealthCon journals and attended almost all the courses of WealthCon. So the initial journey of all the doctors must be same like mine, because we all are having very little knowledge regarding our own finance. So why we are here? We are here to learn about the finance, but this is a disclaimer that WealthCon is an educational platform. It does not provide any investment advice, portfolio management services, or recommendation to buy or sell the securities. The speakers are not SEBI registered investment advisors, and there is no buy or sell recommendations in this lecture. All the lectures of WealthCon starts with a slide that is be smart, means whatever is suitable for you, you take it, discard the rest of the things. Be a student and not judge. So at WealthCon, there is a very beautiful culture that nobody judges anybody. and everyone thinks that they are a lifelong learner. So we all here are to learn and learn from our mistakes and become better day by day. So why we are here today? We are here to learn the systematic way of managing our money as well as life, to begin the journey of financial education, to become the self-reliant in making the financial decisions, and to begin the journey of investing and wealth creation. We do not give any investment advice, tips trading for stocks or mutual funds, intraday trading or sector, or to know how to get rich quickly. So whenever you start your journey, first of all, you should have pure goals in your mind. And how should be the goals? So if I ask anybody that what is your goal, someone will say that I want, some student will say that I want to become a doctor. Someone will say that I want to become an engineer. Or if I ask the doctors, they will say that I want to have my hospital, own hospital. I want to earn 50 crores, etc., etc. But the goal should be specific and measurable. Along with that, it should be time-bound targets. So every goal needs amount, purpose, timeline, and priority. So to aim before you invest, it is very important. And a goal without a plan is just a wish. So suppose I tell that you should include all these things in your goal. So your goal should be specific and measurable, that I want to earn like so much amount, 50 crores or 100 crores by 2030 or like that. So your goals should be specific and measurable. And there are many money myths that are prevalent in the society, like more income means more wealth, investing is only for the rich, timing the market works, insurance is investment, debt is always bad, gold never falls. So we will bust these myths in our today's lecture. So let us start this financial education journey. What we will learn today, we will learn about income management, wealth management, as well as life management. When to learn? From today itself, because आज अच्छा मुहूर्त है. Why we want to learn? Because we all want to be self-reliant in the finance. And where to learn? WealthCon है ना. So in our WealthCon journey, it is like a game of snake and ladders. When we get the ladder, we go up, and when we are bitten by this snake, we come down. So our journey of financial freedom is also full of snakes like loans, EMI, inflating prices, necessary expenses, high taxes, and sometimes some unnecessary expensive tools also. But we need to take the ladders of financial discipline, savings, investment, insurance, and tax saving to reach our goal of 100, that is financial freedom. So if we talk about the personal finance, it is dependent on the different age group. So like in a young adult who is around less than 30 years of age, his goals may be the school and college, getting good marks, and to chill out with the friends. Between 30 to 60 years, that is middle age group, the goals may be career orientation, children, wealth creation. And after 60 years, the goals will be retirement, spending, wealth protection, travel, and socialization. So personal finance is divided into the six sources, that is income, spending, protection or insurance, loan, investing, and taxation. So whenever you are getting some income, out of this 100 rupees income, suppose you are getting 100 rupees income, then we divide this into 5 pizza slices. So out of this, 25% of your income should go for the loan repayment. EMI should never be more than 25% of your total income monthly. The rest 25% goes for the investment, 10% for the tax, and remaining 40% you can use for the insurance and spending. So which are the different types of income we are having? As doctors, we are having two types of income, that is active income and passive income. If you are salaried or job or an employee, then you get the salary as an income. And if you are having your own setup or self-operated business, you will get the professional fees or a business income, that is an active income. While in passive income, it includes investing passive income, like we are getting capital gain, rent from the property. It may be either residential property, which is given on rent, or commercial rental property, interest and dividends that we get on the stocks and mutual funds, and various other passive incomes like rights and royalty and manager operated businesses. So let us learn what is assets and liabilities. So we have options of investing in two things, either assets or liabilities. So what is asset? anything which puts money in your pocket is known as assets. Like if you are having a home and you give it as a rent, so in that case, the real estate property is earning income for you, so it will be considered as asset. Similarly, the stocks and mutual funds which we are getting interest or dividend on that, fixed deposits, business income, all this comes under the assets, because assets puts money in our pocket and make you richer over a period of time. While if you buy anything which takes money out of your pocket is known as liabilities. For example, you purchase a car, then it requires maintenance, timely services, insurance, fuel, etc. So this is a liability. Similarly, if you are taking a loan for home which is owned by you, then it requires maintenance and other expenses. So it is a liability. Credit cards, high interest, EMI, and loans. All of these are liabilities because they take money out of your pocket and make you poorer over a period of time. So your target should be to build asset, limit the liabilities, and create the wealth. So whenever you are spending some money, then you have two choices. Either you buy products of needs or product of prestige. What is PONs? So products of needs are the necessity or essential requirements of your life, like various bills, light bills, gas bills, mobile bills, etc., health related expenses, educational expenses of the kids, and living expenses. While the products of prestige includes those products which are not essential for living, like gadgets, fancy mobiles, cars, luxuries, jewelry items, show off items. So status, social media, and party, these are some of the products of prestige. So whenever you are buying anything, do not buy unnecessary things. Do not buy just for the show off because someone has taken the luxury car or your friend has taken, your neighbor has taken the luxury car. It is not necessary to show that you can also buy it or afford it. Do not buy anything which is on the borrowed money. Do not compromise on the product of necessity. Now, in today's world, the Gen Z population, we all know that they are having philosophy like "Zindagi na milegi dobara," "Kal kisne dekha hai," "You live only once." All these things are true, but anything whichever you want to spend money, that should be only after saving 25% of your total monthly income. So, whenever you buy anything, ask yourself these five questions. Is it essential? Will it improve my life? Can I afford it without any debt? Or will it be beneficial to me in the long term? So, nutritious food, shelter, education, healthcare, savings, investments, insurance, financial security, all these things are products of need and they are essential. While luxury car, branded bags, latest smartphones, expensive vacations, frequent dining out, all these things are products of prestige. And if necessary, we should always try to avoid those things. Then the second thing is the protection of our wealth. So, what is protection? For protection, we need some emergency corpus for any unknown emergencies, and we need insurance like health insurance, uh, car insurance, and other insurance policies. We all know that Rahul Dravid is considered as the wall of India, and he is considered as the best defender batsman. So before getting runs, we must protect our wicket. So if we will save the wicket, we can run or score later on. Whenever we are playing the game of life, we can get various bouncers, yokers, or googlies in the life in the form of death, disease, disability, critical illness, or liabilities, which may be civil liabilities or professional liabilities. And we can come out of this only if we are having adequate protection. So, what is the emergency fund that is essential when you are giving protection to your wealth? So, at least 6 to 12 months of the expenses should be kept in the emergency fund. It should be kept liquid and not invested. So, where can we can park this emergency fund? We can park it in the savings account, liquid funds, flexi deposits, or in the short-term debt funds. So, whenever we know we want this money, we can get it immediately because rainy days don't send an invite. So, for protection, what the illiterate person in the finance do, they will buy insurance policies as an investment. They will use tax saving tool, while the literate person will buy insurance as an expense. They will buy term insurance plan, health insurance, indemnity insurance, and car insurance. These are the basic requirements for insurance and wealth protection. So as we have learned in the earlier slide that the illiterate persons, they will buy the ignorance plan, which includes insurance as well as investment as well as tax saving plan together. And if we take an example, like if the person is aged 30 years and he invests around 1,20,000 rupees annually, that is 10,000 rupees per month, and the um, persons who are selling this investment plan, they will come to you and they will tell that if you invest 1,20,000 a year, after a period of 30 years, you will get 62 lakh rupees. And we will think that, oh, this is a very good amount that after 30 years, I am getting 62 lakhs rupees. We are not going to do any calculation and we just invest the money. And this is a very common scenario with all the doctors because we are very much illiterate in finance. So we invest our money and we start this ignorance plan. But if we calculate this real return of this plan, it is only 5.1% per annum. That is very less and it does not even beat the inflation. While a smart doctor or a financially literate doctor, what he will do, he will get a term pure vanilla insurance plan and he will invest the rest amount of money, that is similar money, around 1,20,000 rupees per year for a period of 30 years in the equities. And if we assume that the equity is giving around 12% return per annum, so the total corpus that will be generated after 30 years will be 2.9 CR. That is around 4.7 times more as compared to the ignorance plan. So don't buy any ignorance plans. Keep the insurance for the protection and invest in the equity for the wealth creation. Same money, smart choices, and better results. Now coming to the loans, we all know that the loan is the modern day slavery, as said by Dr. Ram sir. In the ancient time, the people were working as a slave for kings, but in the modern day, we all are slaves in the terms of we are paying the EMIs and we are working for some other companies. So as I have already discussed previously, if you are taking any loan, your EMI should less than 25% of your total monthly income. So what illiterate will do in the finance? They will spend first and earn later. They will enjoy now and pay later. They will pay to the credit card companies and they will take consumer loans. While what the literates will do, they will earn first and spend later. They will enjoy now, pay now, earn from the credit cards, and they will take only good loans. So which are the good loans? Loans like home loans, hospital loans, business loans, machine loans, or educational loans are good loans because they will uh, help you to build the assets. While credit cards, consumer goods taken for the auto or gadget loans or personal loans, they will help you to buy the liabilities, which will over a period of time make you poorer. So now comes the power of investing and saving. We all have mostly heard this story in our childhood, the story of grasshopper and ant. That during the summer month, grasshopper is very happy, but the ant is continuously working. He's saving the food for the future. And the grasshopper laughs at the ant and says that why you are working so much hard. But the ant doesn't answer anything. And during the winter month, the grasshopper has no food because he had not prepared for the future. While the ant has sufficient food reserve, so now she is very happy. She has no any problem because she had already planned for her future. So whenever you are investing, you should start early, stay consistent, and let compounding work its magic. So when you are investing, there are four choices for investment that we call the acronym as GRED. That is gold, real estate, equity, and debt. In gold, we can buy sovereign gold bonds, gold ETF, gold coins. For real estate, we can buy residential, commercial property, or any land. In equity, we can buy equity shares, index exchange traded funds, equity mutual funds, and debt products like fixed deposit, liquid funds, debt funds, and GSECs or T-bills. So why we want to invest the money? That is a very important question. That if we are having sufficient corpus, why we want to invest? So inflation is the silent wealth eroder, and we all know that what is inflation? It is the amount of the same money that decreases your buying capacity over a period of time. We all know that in 2000, around 100 rupees could buy you 10 cups of tea, but in 2026, it buys only 3 cups of tea. Similarly, the prices of milk has increased from 14 rupees to 65, 80 rupees in 2026. Petrol prices has gone up from 33 rupees to 110 rupees in 2026. So everyday expenses becomes costlier over a period of time. Saving loses the value if they don't grow faster than inflation. Investing is essential to maintain and grow your purchasing power and plan today for a better and financially secure tomorrow. And we all know that inflation is around 5 to 6% per annum, it is increasing. So if you are investing in such products which are giving you only 6 to 8% returns, then you are not beating the inflation. You are getting just 2 or 3% returns, which is very less. So inflation is a rising cost of living and it reduces the purchasing power, and it is a silent wealth creator. For that, we want to invest in such plans which are systematic and they give a compounding effect, and over a period of time, they help in the wealth creation. So for that, systematic investment plan is very important. How the systematic investment plan works, they help in rupee cost averaging. Power of compounding is there. It removes the emotions because we are not seeing our SIP mutual funds portfolio daily. So we are not tempted to sell the ETF or the mutual funds, and it builds discipline over a period of time. So start small, start today, start now. So when we are investing, the investment in the provision for the future spending. Illiterate will do investment based on the tips trading. They will do haphazard and impulsive investment and dumping the money. While literate will do their own research, they will do systematic and strategic investment, and they will invest in different avenues of the investment that we have already discussed, GRED. So never put all your eggs in one basket. So you should diversify all your portfolio into equities, debt, real estate, and gold. Whenever you are investing, you should ask the 6 questions before investing: what to buy, why to buy, when to sell, how much to buy, and how to buy. For that, what to buy, there are various instruments like we have discussed, GRED. Why to buy? Because our purpose is either growth of our capital or protection of the capital. When to buy? If we are not convenient, or if we are not having too much knowledge of market, fundamental analysis, technical analysis, then entry and exit should be cumbersome for any doctor who is not financially literate. So for them, SIP and dip buying is very important strategy. In SIP, you do systematic investment plan. You assign specific amount that is debited from your account and it is invested in the mutual funds. And your exit should be target based. Like if you want money after a period of 7 years for your child's marriage or higher education, you should plan your investment accordingly. How much to buy? As we have discussed that we should not put all the eggs in the same basket. So no more than 25% of your portfolio should go in any of the one type of equity or only debt products or any gold products. And how to buy? That is by the logistic of orders. Like you can open the account with the MFU or any coin account for mutual fund trading. And for investment, you open the account with various brokers which are available. Various investment products which are available, generic products like stocks, bonds, fixed deposits, public provident fund, gold and real estate, while the branded products like mutual funds, direct exchange traded funds, gold ETF, and REIT. We should avoid whenever possible fancy and high cost commission products which are suitable for only illiterate people, like regular plans of mutual funds, insurance plan, ULIPs, that is unit linked insurance policies, portfolio management schemes, Ponzi schemes, multi-level marketing scheme, cheat funds, under unregulated funds, and crypto. So if we talk about gold, we have various options, like we can invest in sovereign gold bonds, gold bees, gold coins, and gold future. In real estate, we can invest in agricultural land, non-agriculture, residential, or commercial building products. Debt funds like bank FD and bonds. Government schemes like Public Provident Fund and Sukanya Samruddhi Yojana. RBI bonds and bills and company bonds. And branded debt products like exchange traded funds, debt mutual funds, ignorance plans, and pension plan. Now, talking about real estate, it is very important, and many of the doctors are having query that where should we invest money in real estate, whether it should be commercial property or it should be in residential property. So it depends on 2 to 3 factors. If we buy the residential property of 1 CR, suppose, and we buy the same amount, 1 CR property of commercial property, you will get more rent on commercial property because rental income of commercial property is higher. But at the same time, the demand for residential property is more. So it is possible that residential property will not stay vacant for a long period of time, while you can have some problems in getting the tenant for the commercial property. Also, it depends on which area you are having real estate property. So this decision should be taken very wisely. So various investment uh, in finance, whenever there is an Indian mentality that whenever you are investing or you are advising someone that you should invest this much amount, then the first thing is kitna deti hai, means what is the return. So according to Ram sir, return should be the last thing to be asked when you are going for any investment. And Ram sir has given very easy acronym for this investment advice, that is CTLRR. That is cost, taxes, liquidity, risk, and return. So return comes last when you are investing. Which are the different costs? There may be entry cost, holding of the cost, and exit cost. We all know that if we are taking money from the or selling the mutual fund, there is some exit loss. So these are the costs for various investment. Then whenever you are booking profit in mutual funds or shares, there may be some taxes like short-term capital gain, long-term capital gain, and tax according to your slab rates. Liquidity, this is very important thing. Whenever you are investing, you should try to invest in those assets which are very liquid. Like I have already discussed that real estate properties are less liquid because it requires a large amount of money. So investment avenue should be such that there should be an ease of exist. Then how will decide the liquidity? So if there is a large amount of volume which is traded, like if we are talking about some shares, so if a large amount of shares are traded on NSE or BSE, it means the volume is large, then the liquidity is good. Similarly, if the price difference between the ask price and the bid price is very less, it means that is very good liquidity. Then whenever you are investing, there is always some risk associated with it, like drawdown risk, volatility, and loss of capital. So what is drawdown? Drawdown is the maximum amount of the down journey of the any equity or any stock price from the recent high. So it can be sometimes 50 to 60% some of the stocks. Similarly, volatility, that is daily up and down in the prices, is known as volatility. And if the market goes down, then there is a risk of loss of your capital also. And in the last, we should calculate the return. So various methods of calculating the return like CAGR, that is compounded annual growth return, then extended investment related return, and rolling return. These are the various types of returns that we calculate. Now, if we look at the asset price behavior for various instruments available for investment, that is equity, gold, and debt, we can see from this three graph that all the three avenues, that is equity, gold, and debt, has risen over a period of time. So they all are in the uptrend. But if we see that how much amount they are rising, then we can see that in equity, there is a strong and long-term growth. Gold has a steady uptrend behavior, while debt has a stable and consistent behavior, but less amount of return. So debt is low volatile, steady, and predictable return. Gold is it is acting as a hedge against the inflation and economic uncertainty, and equity has a high growth potential with a short-term volatility. Now, we all say that we should invest in the stock market or we should invest in the mutual fund. Why? Because there is a power of compounding. So what is power of compounding? When you are investing the money for a long period of time, the time along with the consistency will give you compounding effect, and that will help to create the wealth generation over a period of time. Let us understand this by an example. Suppose if you are investing in Nifty 50, which has given a return of around 12% in past 50 years, and you are investing 50,000 rupees every month, then if one person invests this amount, assuming that the CAGR is 12% for a period of 10 years, he will invest around 60 lakh rupees. And at the end of 10 years, he will get 1 crore 6 lakh rupees. That is 46 lakh rupees increase in his amount. that is around double the money in a period of 10 years. But if he doesn't stop here and he continues investing via SIP, then over a period of 20 years, the invested amount will become 1 crore 20 lakhs. But the return he will get, that will be 3.12 crores. And if he continues this journey till 30 years, the invested amount will be 1.8 CR, but the wealth created will be around 10.5 CR. So by the graph beside, we can see that the green line, it is the investment for 10 years. We cannot see that much growth, but the blue line shows some growth and the purple line shows exponential growth. That is over a period of 30 years, the investment amount has increased by 6.8 times. So this is the power of compounding. Now coming to the taxation, we all know that we have to pay income tax, and according to Ram sir, paying income tax is the highest form of charity. But at the same time, death and tax both are inevitable and we have to pay tax. So what do the illiterate in finance do? Many people have belief that we should not pay income tax to the income tax department. So what they will do, they will generate cash. They will withdraw the money from the bank and they will generate cash. But what you will do with this cash? You will just spend this money on the products of prestige. That will not help to buy the asset and that will not help to create wealth over a period of time. They will do just stuff buying. While what the literate in the finance do, they will save the tax. They will increase this post-tax income. And from this post-tax income, they will buy the asset that will help them to become richer and richer over a period of time. These are the various income tax slabs. We all know about this. Will not go in detail, but up to 4 lakhs, the income tax is nil. Then for every 4 lakhs, there is 5% increase. So up to 24 lakhs, there is 25% tax applicable. And more than 24 lakhs, the tax is around 30%. So someone will ask that out of this, which is best for me? So nobody, no plan is we can recommend for anybody because everyone is different. So know thyself. To know oneself and one's own requirement is very important in life and finance. So best is not always possible, but better and suitable option should be considered. Because whenever you are investing, your target should be fixed like target. So what is the acronym target is for? Time horizon, age, risk appetite, goal, expertise, and time to effort. So your investment journey should be based on these 6 principles. What is time horizon? So if you are a long-term investor or short-term investor, long-term investment is usually considered more than 5 to 7 years period, while short-term investment is 1 to 3 years period. So if you are investing money for short term, like 1 to 3 years, you should invest in debt products. And if your time horizon is long, then you can invest in equities. Age, if you are a young person, you can take risk. So more of your equity investment should be done. While senior citizens, capital protection is their main goal rather than capital growth. So for them, debt products should be more as compared to equities. Risk appetite, someone is having high risk appetite and someone they want to play defensive, so they should allocate their portfolio accordingly. And what is your goal? If your goal is wealth creation, you should give more amount to your equity portfolio, and if your goal is protection, then more amount should go in the debt products. Expertise, whether you are minimally experienced in the share market or if you are having too much knowledge or advanced knowledge, you can decide your investment accordingly. And time to give to the market, whether you want to give only 10 minutes a month, then you should invest only in mutual fund. And if you are having time, you can learn yourself daily after joining the WealthCon fundamental analysis, technical analysis. Then you can invest on your own. You can do analysis and you can invest in share markets accordingly your knowledge. So take home message is you should be self-reliant. You should start learning. You should take actions. Demat account is very important, and I will suggest that all of you should start opening a demat account. You should be able to learn how to buy, how to sell. You should be used to the logistics of the various platforms. Debt clearance, because debt-free life is very peaceful. So whenever possible, don't take loan unless and until it is absolutely necessary. And whenever you are taking loan, remember that good loans like home loans, business loans, which can help you to buy the assets and increase the wealth over a period of time. Always try to avoid the ignorance plan. So I would suggest that from now onwards, if anyone comes to your OPD to suggest you some plans, the first thing you should ask is what is the XIR of this plan? And I am 100% sure that that fellow will not be able to give you the answer. So whenever you are investing in any of the investment policies, first calculate the what is the CAGR or what is the XIR or then plan, and then you decide wisely whether this plan is worth or not. Tax planning is very important. As we already discussed, tax are inevitable, but you should plan your taxes in such a way that it will help to save the tax as well as help your capital building over a period of time. And long-term planning is what we all suggest. So till now, we have learned so many things that what we should do. But at the same time, it is also important to know what we should not do. And this slide is about that. Never outsource the financial decision to someone else. Ram sir always says that if you are buying uh, a shirt or if you are buying a small thing, you go to 5 or 6 different shops and then decide. So why you are giving your financial decision to someone else without gaining knowledge and without studying them? Never invest in the unregulated or fancy products. Never invest on tips, intraday, stop loss trading or satta. Never expect more than 30% annual return on investment because this is like nearly impossible. And Ramsa always says that whenever someone says that I will give you 100% return, then it can be either God or it can be liar. Never transfer the funds to unknown person to avoid the frauds and scam. Day in and day out, we are reading in the newspaper that someone in some cities, some doctors was trapped in the some fraud schemes. So, as in financially highest level of intelligence, we doctors must learn the finance and we should manage our finance on our own. Never borrow money or invest in the stock market and buy the consumer goods. Never buy ignorance or insurance plans for the investment. So, whenever you are buying an insurance plan, Ram sir always says that you should buy pure term insurance plan, that is vanilla plan, that is just to cover your dependents. And we should take the term plan for a period of 65 to 70 years because by that time, most of our kids will become self reliant and they will be self independent for their finance. So never take plan with various waivers or various endowment plans. Never invest in the MLM schemes which are proposed by your friends or relatives. Never hate wealthy people. This is very important because if someone is wealthy, then we sometimes talk foul about the people that they have taken money with some bad investment advice or some illegal things they have this money. So never hate wealthy people. Try to learn finance, and you can also be wealthy. And never stop learning. At WealthCon, we all say that we all are lifelong learners, and we learn by sharing our knowledge with each other. Thank you very much. So you can take a screenshot of this slide. This is the QR code, which is for the WealthCon broadcast channel. You can scan this QR code and you can say hi on this WhatsApp number. Our admin team will contact you and then they will add you in this WealthCon broadcast channel. And happy learning. And I want to thank Dr. Ramshar and coincidentally today is Guru Purnima. So I dedicate my this lecture to our beloved Ramsar. Thank you very much for uh, allowing all the doctors community to become self-reliant to help us in such a way that it has changed the lives of many doctors, including India and abroad. Thank you very much. So, any of the participant has any questions? I would like to request the participants if they are having any questions, they can ask me in the chat box. welcome channel link is also posted in the chat box. Telegram homepage and the discussion links have been also posted. So if anyone is interested, they can join the channel and they can join the WhatsApp group. So if there are no questions from the audience, we can wind up the meeting.
So we can wait for 1 minute. If there will be no
Okay,
question,
sure,
we'll wind up. Yeah, thank you.
sure, sure. So Jigar is asking whether it's a WhatsApp group or channel. So you can scan the QR code and you can say hi on this WhatsApp number, which was displayed on the slide. And our admin team will contact you. You can also click on the link which is given in the chat box. RBI floating rate saving bonds is good when you are want to park the money for debt products because the rate of return will be not that high. So it depends on what is your plan for investment and in what period of time you want that money back. So if you want to park money for a short period of time and the saving bonds are available for a short period of time, you can park in floating rate saving bond scheme. These different debt products and bond products, they are having credit ratings. If you want to invest, then you should check the credit ratings, whether they are triple A, AA, then these are good. But if the ratings are BB, CC, then you should not invest on these bonds. There are no questions further from the audience. We can wind up the meeting.
Sure, sir. we'll wind up.